All right, so we're going to get started today. First, we just want to thank you guys all for joining us today for our webinar, Halftime Report 2021. Just a couple housekeeping items before we turn it over to Ryan, who's going to be presenting today for us. Today's meeting is going to be recorded, and we'll also be having it on YouTube afterwards, which we will be sending out to everyone. For the duration of today's webinar, you will be on mute, but you can use the chat box to ask questions. We'll spend about 15 minutes at the end to answer any questions you may have. We're planning to go around 30 to 40 minutes today for the actual presentation. And then afterwards, turn it over again to Ryan to answer any questions you may have. So with that being said, Ryan, it's all yours.
Great. Well, thank you, Devin, and thank you everyone for being here with us today for our halftime report. Today, what we're going to talk about is a little bit about what's happened over the past 6 months. We'll make some references to obviously everything that's gone on roughly the past year and a half. We'll talk about what lies ahead, what we can look for in the market specifically, and then some investor considerations as time goes on, some things that we're talking to some of our clients and partners about in the market environment moving forward. One of the things that we wanted to carve out a little bit of time in the beginning to talk about is just to thank everyone that's on this call, but also thank others that might be dialing in later, and I guess just express our appreciation for the support. As many of you may or may not know, we were recently nominated by a local publication as one of the best wealth management firms in this area. That speaks really to the support that we get from people like yourselves. So we wanted to take an opportunity to thank you. 2021 is off to another fast start for us. We're having a great year as a firm, and that all can be attributed to you and all of the support we've received from our partners and clients. So thank you for that. With that being said, we're going to kick this off. And we always like to start with a quote, a picture, something of that nature. And so for today, we found a quote from William Feather, and it says that one of the funny things about the stock market is every time one person buys, another sells, and both think they are astute. We like this quote because it's something that rings true on a day-to-day basis. The market, how it works, there's always going to be a winner and a loser. There's a buy and a sell side. What we've seen in recent history with the market is that most people making those trades, those transactions, feel like they're on the right side. We'll talk a little bit about that, what those sides are, as well as what some other institutions think is going to happen moving forward for the rest of this year. And you'll see that there are some differences of opinions. And so we thought that was a little bit of a funny quote. We wanted to kick it off with that. Transitioning into the U.S. markets, we're going to talk a little bit about what's happened over the first half of this year. So this chart represents a snapshot of the S&P 500, and it notes some important events that have occurred over the beginning of this year, really up until around June, end of May into June. And so you'll see on that chart, we have things like on January 20th, the inauguration of the President Biden, his administration, March 11th, COVID relief bill, and so on and so forth. And really the point of this chart is to show that there have been things that have happened over the course of this year that have definitely affected the market, and the news cycle has affected the market in drastic ways over short periods of time. So you can see that some of the things that we would view as positive, you see an upward trend in the market, and some things that might be viewed as negative. Like on the back half of this graph, we talk about the rise of inflation in April and how that's negatively affected the market. Rounding out the end of this graph, what we've seen is some in some places around the country, we have a return to work. Vaccination has increased here domestically in the United States. And we're starting to see the economy pick up steam in various ways, but we'll talk a little bit later about inflation and how that has impacted the market specifically, but how the economic recovery has also impacted inflation and the rise in the costs of goods and services. So I talked a little bit about forecasts. So for the S&P 500, and what this graph or what this chart represents is a prediction of the price value or the price target of the S&P 500 at the end of 2021. So what you'll see here is that there's some very large institutions. What CNBC has done here is they've gathered information from analysts from all over Wall Street and asked them, what do they think when December wraps up at the end of this year? What do they think the S&P 500 will be at? As of today, earlier today, we were hovering right around 4,360 change. It looks like it's come down a little bit. But as you can see, that's right around the target that most of these analysts feel we will wrap up the year in terms of the S&P 500. So the group average was about 4278. So right now we're ahead of schedule. There's a few on that list that finish above that point. You can see there at the bottom, JP Morgan, UBS, Credit Suisse, BMO. They all have a higher forecast for the S&P. So there seems to be some differences of opinion on where we're going to be. At any of those points, most of those points, maybe with the exception of Bank of America, the S&P 500 will finish with positive growth for the year. So the question remains, if any of these forecasts ring true, whether good, bad, indifferent, where are there going to be some opportunities to get rate of return in the market? S&P 500 obviously represents the 500 largest companies in the United States. So we'll talk a little bit about what has been driving stock market prices, but also what drives the behavior around the market as well. So one driver of the stock prices in particular has traditionally been corporate earnings. So this chart goes back to 2010. And so that yellow line is going to represent the price performance of the S&P 500. The gray line is going to represent earnings per share. And so traditionally what we've seen is that those lines tend to move in unison. So if earnings are up, the market tends to reciprocate that. If earnings are down, the same would occur. We see prices come down in terms of the value of stock. What we've seen over the past year and a half is that the gap between the two has widened. So earnings per share has significantly increased, and so has the market. So they're still moving in the same direction, but the prices of some of the stock that we see in the S&P 500 have increased substantially above the earnings per share. So if you watch any financial news, you'll hear terms like valuations, multiples, things of that nature that are expressing an overvaluation. Stocks, many analysts out there believe that some stocks in the S&P are expensive right now, and this is basically what they're referring to. The earnings potential and the earnings power of the company does not necessarily match up fundamentally with the prices that the stock is trading at currently. But traditionally, corporate earnings have always been a driver of stock prices. So what that means moving forward is as the economy continues to reopen, as GDP grows, as earnings for corporations increase, you're also most likely going to see an increase in stock prices over that period of time. To what extent? Primarily will be market driven, and some of it is investor behavior driven as well. So let's take a closer look into what actually drove equity performance over the past 6 months, but also over the past 10 years or so. So one of the things we always look at are economic and financial indicators. And so this is a snapshot of what we were looking at in 2011. And so I'll focus, you'll see a lot of green on that screen. I'm going to focus on some of the neutral and negative. So the political environment at that point in time was viewed as a potential negative. It could have a negative impact on investment. Volatility levels, we were neutral, almost green. Housing and mortgages, same, and credit availability. And so coming out of the financial crisis, availability of money and capital was much more strict, obviously passing of legislation. And so banks and housing and mortgages were directly affected by that, obviously, too. And we saw a lot of volatility in the market. We saw a recovery, but there were also some volatile periods in there. And so what we look at here is a trend. So let's fast forward 10 years to January of this year. And what we'll see is that there's a lot less green and a lot more neutral. And what that told us was that analysts were proceeding with caution into the future. After 2020, a lot of things happened. March was a really rough month for the market, and we saw that the effect of a global pandemic and what that does to the markets, what that does to economies, and how that can change market outlooks. So we'll see some things had transitioned to that point. The yield curve, labor market, obviously many businesses were shut down. Business spending surveys, they were neutral. Obviously businesses weren't spending money at the same rate. Equity market valuation was somewhat neutral. And then you saw credit availability and energy costs also neutral, with the negatives really being the political environment and the geopolitical environment. The changing of an administration always sparks I guess, a sign of caution in financial and economic indicators, especially in the first 100 days of a presidency. There's a lot of initiatives that get rolled out, and there's a lot of things that get talked about. Also, geopolitical risk, the passing of the torch to a new regime in terms of political parties. What effect is that going to have on domestic relationships abroad, and how is the rest of the world going to react to that? So if we look into April, what actually ended up happening, a lot of things went positive. And so there's a lot of different reasons for that. Vaccination rates are certainly one, the reopening of economies, not just in the United States, but abroad. And so we saw a lot of things stabilize with a reopening initiative, obviously some stimulus and some other things that happened. However, we did see a big jump over the course of the past year, really, in equity market valuations, meaning that prices of stocks have increased significantly, but proportional increases in things like earnings, corporate profitability, and the like have not necessarily increased at the same rate. So that's a sign of potential caution moving forward, just paying attention to equity valuations, making sure that you're not buying into specific points of the market where things may be overvalued or buying at the peak. Geopolitical risk and political environments still exist. A lot of conversations have started on other initiatives of the Biden administration, not being completely out of the woods with the pandemic at this point, has tabled a lot of those conversations. And so a lot remains to be seen on how that's going to affect the market, how policy may affect the markets long term. But as of right now, it's viewed as a neutral impact on investment until we see some more movement and some more changes in the political and geopolitical environment. So let's look at the second half, and let's talk a little bit about market forces. So the big topic of conversation today is inflation. Everyone is talking about inflation. And so the price of goods and services in many segments of the market have increased. Now, why is that? There are a number of different reasons, but ultimately what it boils down to is pent-up demand, having economies that have been shut down for extended periods of time. What we saw is that many people around the country actually saved their stimulus money. They did not save it. Savings rates went up significantly, as reported by many financial institutions. And so what we saw is that coming out of a pandemic and reopening phase of the economy, people were spending more money. Demand was increasing. However, supply was not keeping pace. So we're seeing that a lot in places like the automobile market, where just vehicles are not available. There's microchip shortages, there's inability to manufacture efficiently. And so all of that is driving prices to a point where inflation is greater than obviously increases in wages and the like. So there's a lot of talk. Is this transitory? Is this something that's going to be permanent? That remains to be seen. Our view and our take is that for some of these segments of the market, it is most likely transitory. It's a supply chain issue, and once that gets resolved, prices will stabilize. But in other areas of the market, that remains to be seen, and some of that transitions back into the political environment as well, in terms of spending initiatives, budgets, and where stimulus may be going in the future. The infrastructure package is one that is a big bill. What actually ends up getting passed, that's up for discussion, and so all of that will be something that will be in our sights moving forward to make sure that we're keeping an eye on that. And so this chart is actually a representation of the annual percent change of inflation. And you can see that different periods of time, different market environments, have changed over the past 20 or so years, have caused inflation, U.S. core CPI, so that does not include food and energy, to increase and decrease at various points in time. So you see that midline is kind of right under that 2% mark. That's about an average over that period of time. So the Fed has been very open and transparent about the fact that they want to see inflation at around 2%. That's a number they're comfortable with. The average has been right in that range. Obviously, that came down. You'll see in that 2020 number came down a little bit, but over the past few months, we've seen it spike significantly. And that just points to some of the things that I just discussed on pent-up demand, availability of goods and services, and ultimately what companies have to charge for that in the event that they don't have supply coming in to replace those goods and or services. So the inflation trend chart that we're going to show here is really just another historical look. We're mapping it out even farther into the past, and you can see that the headline CPI, so since 1970, has been right around 3.9%. And so that's a much larger average. You'll see some big numbers in there. Obviously, in the 1980 and 85, we see north of 5%, as high as 15 in some periods of time. And these are seasonally adjusted because obviously certain points of the year, certain items inflate more than others. For example, energy during periods of the year based on weather around the country. But ultimately, what we're looking at here is the core CPI in recent months has increased significantly to a point where it's creeping up at that average. And that's an average that includes some pretty big numbers from the past, and it's been traditionally pretty low in recent history, as you can see. And so that's just something that I think shows you will see a little bit of a spike here on the end in that yellow line. And that's something that's up for discussion, and that goes back to the original point of, is it transitory, meaning is it basically temporary, or is it something that's here to stay, and are we headed on a path like we see over here on the left side of the chart? Our view is relatively neutral on that. We think that some parts of the market are transitory. However, budgeting, spending, deficits, things of the like, tax policy, all of that could effectively change in the future. And also the Federal Reserve's position on policy could also change those numbers significantly. So inflation expectations, basically what this chart is telling us is that there's a lot of growing anxiety around inflation. Their inflationary pressures have really exerted themselves in everything, in every subset of the market, commodities, consumer goods. There's a lot of different reasons for this. We talked about, bottlenecks in the supply chain. The concern that we're going to have long term is that the Fed may tighten monetary policy sooner than they anticipated. So there's been a lot of talks and a lot of periods of time thrown out there, 2022, 2023, in terms of interest rates and other monetary policies. If inflation goes on a run and gets out of control, that may cause them to tighten the belt a little bit sooner rather than later. Because they do want to stop any acceleration in inflation and ensure that it is truly transitory. The market doesn't always agree with the Fed. We will say that, and the market does not always act logically, as we've seen over the past year. For most of 2020, most parts of the country were pretty much shut down, and we saw the market go on a historic run from its bottom at the end of March. So, this chart is really just showing 10-year inflation expectations, and we're seeing that they're rising. So people believe that inflation is going to go up over the next 10 years and that there will be an eventual break even. But at this particular point in time, we're actually above that break even rate. So it'll be interesting to see how the market reacts, but as well how the Federal Reserve reacts in bringing that down to, I think, a more reasonable number, and also understanding investor behavior around, as they see those numbers change, what might happen in the market itself. So shifting focus away from inflation and just talking about equity market valuations, that was something that was a point of caution. So this chart measures essentially value in the equity markets, both the rest of the world and the United States. And so this is what's referred to as an inverse relationship. So the high points on the bar are periods of value. Those are periods of time where you can find value in the market. Equity valuations are tend to be a little bit lower, and you can find things relatively cheap in comparison to some of their fundamentals. The lower points on the bar suggest that there may be some overvaluation or expensive equities in the market today. And so what you're seeing here is really a bleak picture of a longer run outlook. It's not to say that money can't be made in the market, but finding value is going to be increasingly important. And so what we've seen in the index investing world is that when you're investing in an index and you get stocks like the Apples, the Amazons of the world, they tend to bear a large portion of that index. And so they can essentially drive the value of those funds up, but they can also drive them down. And so we'll talk a little bit about some strategy around ways to find value in the market today, whether you're taking a traditional or non-traditional approach, how to approach this to ensure that from a financial planning perspective and an overall investment performance perspective, that you're getting what you need out of your portfolio and that you're not buying into the market at expensive periods and then ultimately selling in a down market. So one of the things we do focus on quite a bit, we talk a lot about diversification, and diversification is not just a stock versus bond, equity versus fixed income conversation. It's also a US versus the world conversation. What weighting are we going to have around the rest of the world? And this is a chart from JP Morgan's Guides to the Market. One of the things this chart depicts is how the US or the EAFE, which is essentially developed countries around the world, how it has outperformed the other subset of the market. So US versus the world, the purple represents the world and the gray portion of the chart represents the United States. And so what we can see is that at various points in time, the United States market has outperformed, but there's also periods of time where it's underperformed. And so really all this chart speaks to is the need for diversification and kind of spreading, not putting all our eggs in one basket. If you were invested in domestic equities over the past year, you've done fairly well. Some of that depends on your timing, when you bought in, but ultimately your performance has been significantly better than had you invested all of your money around the world. However, if we back up from the tech bubble in the early 2000s and 3 down market years from the S&P 500, and then essentially a flat year or a flat decade from 2000 to 2009, we see that international markets actually outperformed the S&P in a period prior to that. The U.S. outperformed, and so it trades places in periods of time, and that just speaks to the cyclical nature of the market, not just in the U.S. but abroad. And so one of the things we like to focus on is we've talked a lot about in this presentation, the S&P 500, what's happened in US markets, but there's a lot that's happened overseas, and there's a lot that still remains to be seen in terms of overseas investing and investing internationally, with their economies still reopening, vaccination rates potentially being lower in some countries and starting to increase. So these are things we want to keep an eye on because they can be return enhancement assets in a portfolio, potentially in periods of time where maybe the U.S. does not outperform as significantly as it has over the past, really 14 plus years. So interest rates are a big topic of conversation. We looked at some of those charts from the past and we saw inflation rates. Interest rates have also been traditionally higher, and those also fluctuate with market conditions. So what's ahead for short-term interest rates? There are some Federal Reserve meetings coming up in the near future that are going to shed some light on, one, the Fed's policy around inflation, but also their policy around interest rates, what they think an appropriate interest rate level is, when they will intervene or when they will stop intervening, and to suppress that and allow interest rates to continue to potentially rise here in the near future, whether that's some of the dates I mentioned, 2022 or 2023, or whether that's sooner. And so those meetings, that open market committee has those meetings scheduled, and those meetings will shed some very important light on that information so that we're better informed of what to expect moving forward. Why is the focus on interest rates important? Well, that affects the fixed income market. So bond prices and interest rates have what are referred to as an inverse relationship. And so that means when one goes up, the other comes down. And so we showed that in a nice little graphic here. So as we see interest rates rise, we'll see bond prices decrease. And the closer you get to that in the yield curve in terms of duration, so you see 10, 20, 30, the longer out on that yield curve you go, typically the higher the interest rate in a normal yield curve environment, so normal interest rate environment. And so we're going to be keeping a close eye on that, because as those rates creep up, that's going to have a direct effect on how clients are investing in fixed income in their portfolios, and if that is still potentially a viable asset to use as a diversification tool. Unfortunately, in recent history, fixed income has been pretty much, I would say, I don't want to say non-existent, it's still existent, but it's been pretty much a hedge. So the purpose that it's served in recent history, with interest rates being where they are, is that when the equity markets go down, you're really not losing very much money in your bond portion of your portfolio. And so that allows for a lesser drawdown or smaller losses in the portfolio, which allows you a shorter runway to potentially recover from that. What we've seen based on this chart, this is basically showing us likely bond yields versus the yield to worst versus a 5-year total return. So just, boiling this down into layman's terms, these two lines go hand in hand with each other. They're pretty closely related. And so ultimately what we're seeing is that yields are probably going to stay in the 5-year time horizon with the U.S. aggregate bond index in that 1.5% range. So with that, and with inflation even being potentially at a 2% rate, fixed income isn't going to offer much. So it's a little bit of a bleak outlook in terms of rate of return realized from fixed income, but it is still a good risk diversifier in a portfolio if used appropriately. So it's not going to be the years of old where you could see those big numbers on the left side of the chart where you can get 14% in a CD at a bank. We will see those rates potentially come up here in the near future, or in the possibly distant future, but ultimately we want to keep an eye on two things: interest rates and inflation, and make sure that your money's not going backwards. So if rates are really low and inflation is high, those are things that will ultimately lead to a risk-adjusted rate of return, or a real rate of return that could potentially be negative, meaning that it's no better than just having cash in the bank. So we're going to be keeping a close eye on that, and a lot of that has to do with some of the Fed meetings coming up. And so, not to paint a bleak picture, there are certainly ways to combat this, but we just want to be transparent about the data and what potentially is to come. So I talked about all these things: the good, the bad, the ugly. So the natural question is, well, what can investors do? And ultimately, it's going to boil down to staying focused on the fundamentals. So this is one of our favorite charts, also from the JP Morgan Guide to the Markets. This is the S&P 500 intra-year declines versus the calendar returns. So we focus a lot on this. So the yellow dot at the bottom of that chart is showing that at any point, basically the lowest point of that calendar year, where the market was in terms of being down. And so inter-year drops of 14, it says despite average inter-year drops of 14.3%, annual returns ended up being positive in 31 out of 41 years. So this really speaks to investor behavior, making sure that we're staying focused on the fundamentals, not getting overly emotionally attached to the movements of the market. Because as we can see, if we go back to 2020, at one point the market was down, the S&P 500 was down 34%. Now, by the end of the year, when we wrap things up in December, it was up a positive 16%. So that's a huge swing. Those are opportunities as well intra-year where you can take advantage of potential opportunities to possibly infuse money into the market. And we saw some clients do that last year that had cash on the sidelines and had the ability to do that, and they were greatly benefited for that timing. You know, it doesn't always work out that way, but the point of this chart is really just to speak to, don't get overly attached to what's happening in any given month throughout a year, because as we can see, even though there were pretty large declines at various points, there were minor corrections or sell-offs that in most years, 31 out of 40, the past 41, we returned to positive territory, and the S&P 500 actually finished positive for the year. Tune out the noise. So this is a really powerful chart as well. One of the things that we often get approached with is, do you actively manage money in the sense that you're moving it in and out of the market based on, you know, various factors? And the short answer to that is most likely no. And here's the reason why. When we look at history and we look at the investment performance of, in this case, starting in 2006 with a $10,000 investment, and this comes from our friends over at Putnam Investments. If you had stayed fully invested during that period of time, which includes 2008, 2009, it includes some other periods, you know, 2018, the end of the year there was a little choppy. And so had you just stayed invested over that period of time, you would have earned an annualized total return of 9.88%. So your 10,000 would have turned into $41,100. Now, if you were to move money in and out of the market, and this really goes back to the last chart, you see a trend, you're not comfortable with it, you know, and that's too much risk, you don't like it, you pull money out of the market. Here's the effect of missing a certain amount of days in the market. So if you had missed the 10 best days of market performance over that period of time, essentially 15 years, you would have changed your rate of return. You would have basically halved, actually more than halved your rate of return. So that now you're looking, instead of 9.88, you're at 4.31. Had you missed the best 20 days, you're barely positive. You missed the best 30 days, you're negative. And if you miss the best 40 days, you know, you're even farther in the negative. You've actually turned your 10,000 into 5,205. So what's the point here? The point is that getting invested and staying invested is important. Part of that is really truly understanding your risk tolerance. Some of that has to do with timing as well. The starting point certainly matters in investing. And so what I mean by that is that the sequence of returns are important, and they're also individual to each investor. One of the things you really want to stay away from, and we call it our cocktail party conversation, is I did this in the market last year. I got 30%. What did you get? You know, doing the comparison like that, it's not really a true and fair comparison. Or even looking at things like average rate of returns of funds over a period of time. Because ultimately, historical data and compliant data from the financial industry is a point-to-point measure. And so if you're not invested in that point-to-point, or your investment experience is different, your performance is also going to be slightly different. So we definitely think that timing matters in the sense that where you start is going to determine potentially where you finish. And along the way, there's going to be ups and downs. And so what you don't want to do is move money in and out of the market emotionally and potentially miss those 10, 20, 30, 40 best days. And that's really easy to do when we're talking about time horizons of 25 plus years. It's really not that much. I mean, you get into the conversation of it's a day a year potentially. And that's a big deal. So, you know, every investor has one market cycle that is their own. And that's really important to understand. And that's part of tuning out the noise, is that your investment cycle is your own. When you get in the market and when you get out of the market is very specific to you as the individual. So trying to measure that up or benchmarking that sometimes can be challenging. It's certainly not, I'm not saying that it's not worth doing, but it's just important to understand that your experience may be different than others, and that any two people invested in the same portfolio, if they start at different periods of time, inevitably there are going to be some differences. So the best thing that you can do is fully understand your risk, understand what's important to you and what you need to achieve, what your risk capacity is, what you need to take in order to achieve your goals, and then ultimately sticking to it. Because as we can see from this chart, having the conviction to stay fully invested, even in up and down markets, you're ultimately going to be rewarded for that discipline. So here's where we get into some, I would say, recommendation phase of the presentation. And so I'm going to talk briefly through some of these strategies. We talked a little bit about equity market valuation, how equities might be a little expensive in today's environment. There are certainly opportunities to find value. A couple different places that we're seeing that are dividend paying stocks. Value investing has definitely made a comeback. Growth has dominated in recent history, and you've seen that great price appreciation in a lot of stocks. But a value-based approach, there is some value to be had out there, and dividend-paying stocks is one in particular that we look at, as well as emerging markets. So that's really smaller countries around the world that are growing at a rapid pace. They've generally underperformed. Both of those asset classes have generally underperformed the S&P 500 over the past really 10 years. And so those are some places where you can find some cheaper valuations, some potential opportunities to find value, and ultimately get a more enhanced rate of return in a market where the outlook is fairly neutral, in the sense that we're looking at more conservative projections of rate of return rather than, the 7, 8, 9% that some people may have had conversations about in the past. So the first strategy to consider is tactical asset allocation. So really what we mean by this is active management, in the sense that we're looking at short-term trends to keep up with market forces. So not necessarily tactically or actively managing in terms of getting money in and out of the market, but looking at trends and figuring out how we can manage against short-term market forces like inflation, like interest rate environment, and be somewhat a combination of proactive and reactive to things that are changing in the market. And this can be used in a traditional sense, meaning that, having a fund lineup and an allocation is one thing, and it may just be rebalancing within that allocation to put yourself in a more advantageous position over time. Another thing that's going to go into that is risk mitigation. So really, this is just trying to reduce large drawdowns. And what that does is that reduces recovery time. So what I mean by that is, if you were fully exposed to the 30% drawdown or market loss in March of 2020, the recovery time for you was significantly longer than someone that was maybe partway invested in the S&P 500. So an all S&P 500 investor bore that risk 100%. A 60-40, so 60% equity S&P 500, 40% bond, saw significantly less drawdown and a much shorter runway to recovery, meaning their portfolio got back to even faster. So there's a number of different ways that you can mitigate risk in a portfolio. Ultimately, it comes down to your individual situation, risk tolerance, risk capacity. We talk a lot about that in our practice, and we use some software-based tools to measure that. But those are some things that you'll want to look at and have conversations around, or think about if you're looking at your portfolio and you're wondering about ways to make adjustments in this environment. Active stock selection. So not to be confused with stock picking. Active stock selection, what we're saying about that is, we talked a little bit about what we refer to as the lost decade, 2000 to 2009 in the S&P 500, where no one really made, if you were in an index fund, you made no money. It was flat for that period of time. However, there were people that made money domestically because they owned a diversified portfolio of other stocks that weren't heavily weighted in the index itself. And so what we mean by active stock selection is intentionally picking stocks in different segments of the market and ultimately getting a big basket of well-diversified, less concentrated positions. By doing that, we can also hedge our risk slightly, but also give you the opportunity to not be tied to the daily movements of an index like the Dow Jones, the S&P 500, the NASDAQ. So it's a different type of diversification by using individual stock positions to do so. We've done that with some of our clients in the past. We have tons of clients that have their own portfolios outside of our firm that do that as well. And so that's another way to potentially diversify to help maybe possibly enhance some rate of return over the long term as we transition into an outlook that's a little bit more neutral in terms of equity performance. Alternative investments. So this is one that has not been great over the past decade. I mean, commodities and some other areas of the market, it's been relatively flat, potentially even lost some money. It's not something that has been overly exciting. Alternatives are always used as a risk hedging tool. They tend to have an inverse relationship, meaning an opposite relationship to other parts of the market. One place where alternative investments can be particularly valuable is in a sustained inflation environment, meaning that if inflation continues to go up, alternative investments can be a great tool to diversify to help combat that in your portfolio and potentially maintain pace in terms of performance. So that could be promising. The last piece is satellite investing. So what we mean by this is looking at maybe some non-traditional or more unique strategies that give you a possibility of a risk-adjusted rate of return that's greater than other parts of the market. And so that can be funds or specific managers that have an enhanced return focus. So their focus is they're trying to beat the S&P 500 or they're trying to outperform a particular segment of the market. Others may be a little bit more active in nature. They manage in a particular way and they look at a set of technicals or fundamentals, and they're managing in terms of trading money in and out of the market within that specific fund in order to offset or have an inverse relationship to the market itself. And so all of the portfolios that we manage here at StatonWalsh, we take more of what we refer to as our core approach, which is your traditional investment lineup. And we do a core satellite approach with pretty much all of our clients. And that's just looking at different segments of the market and making sure that we're well diversified across the board. And so a satellite investment strategy as a complement to your core portfolio as it stands today could be something that could be helpful to help potentially bump rates of return, especially if we get into an area where general consensus on the S&P 500 is somewhere in the 3 to 5% annual rate of return range, as opposed to some of the ranges it's been in the past, which is upwards in history, upwards of close to 9%. So these are strategies that are very specific to individuals. It's going to be risk-based in terms of how much risk you're willing to take. The life cycle of the client, whether you're in early phase accumulation or you're in retirement income phase. And there are different tools and different types of accounts and different types of mechanisms out there that can all be used to manage that and make sure that you're getting exactly what you need out of your investment portfolio. So those are some things to consider. We talked about a lot today. There was a lot of technical items in the presentation. What I'm going to do now is I'm going to transition into the Q&A, and feel free to ask any question. If you have something more specific that you'd love to ask, or if you want to go back and revisit a slide, I'm happy to do that. So now, Devin, I will kick it over to you and let me know if we have any questions or if anyone wants to chime in.
Awesome. Thanks so much, Ryan. So we just had a question come in. So with your active stock selection strategy, what are your thoughts on the banking, construction, and telecom industries?
So in terms of banking, I think those are stocks specifically that are going to be very interest rate sensitive. So as interest rates can tend to creep back up, we ultimately see a correlation there with the performance of banking stocks. Banks traditionally too are dividend paying stocks. A lot of them peeled back those dividends in the midst of the pandemic. Federal Reserve was doing audits and reserve requirements were changing. There was a lot of moving that happened in those stocks. Some of them are starting to really pick up their dividend paying again, or their dividend rates. So those are stocks that I think could potentially be of value in a rising interest rate environment, as well as a portfolio where you're looking for a dividend paying stock that has a strong balance sheet. Now, the financial industry as a whole it's going to be specific. There's a lot of merger and acquisition happening right now as well. So it's important to understand your position and what that individual position, what effect that will have on the portfolio itself. But ultimately, I think in an environment where we're heading, that could be a positive place, and that's a place where we see some of the managers we use as well as some of our clients investing money. In terms of construction, obviously there's a lot of that's an industry that has done actually fairly well, especially in our area, in the Baltimore, D.C. metro area over the past year. I think that's something that certainly you want to keep an eye on. My personal outlook on it is some form of an infrastructure package is going to happen. The question is going to be which companies are going to get the contracts. So there's a couple different sides of construction industry. We actually work pretty heavily in that space with businesses in this area. There's union shops and there's merit shops. And so the difference between the two could ultimately have an effect on who's going to get jobs versus not. There's been some ideas kicked around about offering priority to bids from union companies that are represented or employees that are represented by labor unions. There's some other legislation as well that's been around for quite some time that's specific around how workers need to get paid that could ultimately affect the bidding. So my overall outlook or my overall personal and professional opinion on construction is it's a good place to be. The question is going to be which companies are going to win the work. We're going to see a lot of the majors of the world win a lot of that work, but there's also going to be some other areas of the market where you might be able to find value in companies that are going to get historically large contracts that they typically didn't. Where I would look in that space as opposed to the contracting companies themselves is the heavy equipment providers, because that's going to be a market where companies are going to be purchasing and leasing more equipment. That's going to be a market that I think you're going to see a lot of upside potential as opposed to the construction companies themselves. And not to say that they won't, it's just that's going to be more company contract bidding specific, and the government procurement process is a little tricky around that. But the heavy equipment, that's going to be necessary no matter what type of shop those companies are. So that's something that you definitely want to keep an eye on. And then, sorry, Devin, remind me of the last one.
It's telecom.
Telecom. Okay. So it depends, what area you're talking about. And when we talk about telecom, like a Verizon, AT&T in that fashion, and a utility environment, the growth of 5G, those companies also traditionally pretty good growth potential, also great dividend paying potential. So that's another area of the market that I could see being particularly strong. They're also continuously diversifying their businesses. And in a lot of areas, Verizon in particular is one that's huge. They're not just most people think of it as Verizon, a cell phone company. They're much, much larger than that. They have a lot of exposure, and a lot of these telecom companies do have applications across multiple industries, the defense industry being one of them. So I think that's something that could be particularly strong. And so that's a little bit of a different spin on tech. Industries where, we may see some plateauing are going to definitely be some of these technology companies that have taken off significantly. Some are going to continue to move along. In the fintech world, financial technology, that is something that I think is going to continue to be an evolving animal. And that's something that you've seen if you pay attention to stocks like PayPal, that's grown significantly. And it's probably going to continue to do so. Square is another, merchant services, payment collections. The world is becoming more tech reliant. And so in those types of environment, in the environment that we're in today, I think those are going to be particularly important and potentially even have some opportunity to continue to grow. However, in a fundamental sense, some of those technology stocks are significantly overvalued in the sense of their, price to earnings, and some of the other ratios that we look at are historically high and historically expensive. So you just want to proceed with caution. The one thing you never want to do in investing in any industry is buy high and sell low. But sometimes it's emotionally hard not to do that when you buy in at the peak of something and you get 12 to 24 months in and you don't see anything trending upwards, you're only going backwards, and you try to cut and run. You want to cut your losses. So those are things to keep in mind, things that we're looking actively at. But in the active stock selection portion of that, those are the industries that were mentioned in the question. Those are industries that we're keeping a very close eye on. Those are industries that we have exposure to. And there are others, and really depends on the type of client. I mean, there's no one size fits all, of course. When we look at dividend paying stocks and a dividend producing portfolio specifically, you're going to see a lot more of those financials and potentially utility or telecom companies, because they traditionally do pay higher dividends. And there's been some investment in some of those larger domestic companies that we're familiar with. And there's also some exposure to some international companies that are growing.
Great. Thanks, Ryan. Any other questions today? You can just pop them in the chat and we'll have them answered for you. Give you a couple more minutes to ask any. And while you're doing that, there is in the chat, Ben Gutman actually put in there the link to vote, and his company, one of our great partners, North Central Insurance Agencies, also was nominated for Best Insurance Agency in the Maryland area. So if you think we do a good job, make sure you check out that link and vote for all the great companies. Well, if there's no other questions, we really appreciate everybody tuning in today. We will follow with everyone. We will send you a recording, which will be on YouTube, of today's presentation. And if you have any questions at all, feel free. We can set up a time to talk, answer any further questions you may have. Thanks, everybody. Have a great day.